2023 Board of Retirement meeting. Ms. Zeller, if you'll perform roll call, please.
Mr. Land?
Here.
Mr. Kelly is absent. Ms. Cavanis?
Here.
Mr. Jurdy? Mr. Cromer?
Here.
Mr. Shoemaker?
Here.
Ms. Harris? Mr. Swope is also absent. And Ms. Pierce?
Here.
Thank you.
You'll please stand and join me in the Pledge of Allegiance. That brings us to public comment for items not on the agenda. Members of the public are welcome to address the board on subjects both on and off the agenda. Do we have any public comment at this time, Ms. Zeller?
There is no public comment.
Takes us to item number 1, discussion and possible action regarding election of Board of Retirement Officers for 2023, 2024, and appointments to the Audit Committee and ad hoc committees. As far as the Board of Retirement Officers, I believe we have some interested candidates. My understanding is that Trustee Cavanis is interested in serving as our chair. Our Vice Chair, Mr. Shoemaker, is willing to continue serving as our Vice Chair. And Trustee Land is interested in serving as our Secretary. Do we have any comment from any of our other trustees or interest in any of those positions to talk about?
Chair, I'm glad to support the chair in the position of vice chair. I will say now that I will be absent for 3 meetings. Is my participation in the evaluation process. Let's see, I got something covering it. I'm good. Okay, in the evaluation process, probably won't occur due to the timing of being gone in all of May and all of July. And then my other time gone will be in September likely. So that's just a heads up. I'm glad to do that. If there's somebody else that feels they can better do that, I'm glad to let that person take a crack at it. And I'll support them any way I can.
Thank you, Vice Chair. Any other comments or interests for any of those positions? Do we need a motion for that?
I think so. I move the slate as, I'm sorry, I'm not going to move it. I'm not in good shape this.
Okay. We have a motion regarding the suggested or slate of Board of Officer candidates.
Need a second?
So moved.
I'll second.
There we go.
Any additional comments regarding the officer positions?
Well, thank you. I'll do my best.
I appreciate that. Thank you. Any public comment regarding the officer positions?
There is no public comment.
For council, can we take a vote on that, and then the ad hoc or appointees and the other committees, right?
You can do the vote now and then talk about the ad hoc.
Thank you. We can do a roll call, please.
Mr. Land?
Aye.
Ms. Cavanis?
Aye.
Mr. Jurdy?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris? Ms. Pierce?
Aye.
Thank you. Approved.
That brings us to our committees. We have the Audit Committee, where Trustee Anderson was serving as the chair and his term has ended. Also on the Standing Committee for Audit is Catherine Cavanis, Trustee Jurdy, Trustee Harris. Are there interests from those members to continue serving on the Audit Committee?
Yes?
Trustee Harris? Okay. Do we need 4 members for that, or is 3 sufficient?
I was just looking to see, I know you can't have more than 4. Doris?
I believe you can have 3 member audit committee.
Are any of those members that we just discussed interested in being the chair of the Audit Committee?
Sure, yeah.
Trustee Jurdy has volunteered to be the chair of the Audit Committee. I believe that can be an appointment, correct? So those will be the appointees to the Audit Committee. Trustee Cavaness, Chair Jurdy on the Audit Committee, and Trustee Harris. For the Strategic Plan Board Project Ad Hoc Committee, that was from July of 22. I don't know that we need that committee standing.
We do actually have a couple of items in front of the committee currently, including the risk assessment and potential development of an internal audit. So we would like this committee to continue, whether or not the current members would like to continue to serve, or whether it be another.
Mr. Burke?
So the Audit Committee charter states that the board chair will appoint 4 members of the board to the Audit Committee and designate 1 to serve as the chair.
Okay. Mr. Trustee Land or Trustee Pierce, are either of you interested in the Audit Committee?
This is Sarah Pierce. I don't mind being part of the committee.
Okay. So our slate would be Trustee Jurdy as the chair, Trustee Cavaness, Trustee Harris, and Trustee Pierce would be the appointees on the Audit Committee. Strategic Plan, that would be currently serving Trustee Jurdy and Trustee Cavaness. Are there interest from any other members, or are those members interested? Okay. Seeing no other interest, those 2 can remain appointed to that ad hoc committee. And as far as the Labor Negotiations Committee, do we need to renew that, or can that dissolve until there's a need for it? Okay, so there will be no appointees to the Labor Negotiations Ad Hoc Committee unless it becomes necessary in the next year. Is there any other comment from trustees regarding item number 1?
I make a comment that I think the title of that last committee was probably a misnomer, and that if that same committee comes up for the same reason, it should be called the ED Compensation Committee or something else.
Okay. If that comes up in the next year, we can address it at that time. Is there any other public comment regarding item number 1?
There is no public comment.
Thank you. Item 2, discussion and possible action regarding adoption of the 2024 board meeting calendar. From my review of it, it appears they will all fall on the 3rd Wednesday, unlike some previous years where we moved November or December meetings due to conferences or conflicts or holidays. Is that correct?
The month of December is the 2nd Wednesday.
The second one in December, thank you. So December is the only outlier for the proposed.
And no, I'm sorry, that is correct. Only December.
Okay. Do any trustees have any known conflicts with the proposed agenda calendar for 2024?
I don't have any conflicts, but I just wanted to mention that the clerk of the Board of Supervisors has put out a request for all of us who serve on other boards to pass on to our other boards that in future years, in 2025 and beyond, in the perfect world, our other boards would not meet on Tuesdays or Wednesdays, because what's happening is that when we have 2 meetings in a week, it sometimes was that we would meet on a Monday and Tuesday, and it seems to be shifting to Tuesday, Wednesday. And so again, not for this calendar year, but for people to be thinking about maybe for 2025, is if none of our boards met on Wednesdays, like they don't seem to meet on Tuesdays, then we could have back-to-back, or not me, but the future board members could have back-to-back board meetings on Tuesday, Wednesdays. And so that would, for this board, for example, it might mean the 3rd Monday or the third Thursday of the month. So I mentioned this to the executive director, and I just thought I'd mention it to the whole board.
Thank you.
Question.
Vice Chair?
Dan, how many Wednesdays did you guys meet in the last 12 months?
Well, again, they're shifting it for next year from sometimes being a Monday, Tuesday to being it's always a Tuesday, Wednesday, when there's a Wednesday
Okay,
meeting,
so
or when there's a
just
second meeting.
total calendar shift. Okay. Thanks.
There is no conflict for next year in 2024, but they did kind of have to move the Tuesday, Wednesday meetings that they're coupling together sometimes to different weeks than they might have otherwise selected.
Thank you for that. Was there other comment? Trustee Harris?
I'm glad we're keeping the December, the second Wednesday. And back to my encalsters, this is what we did. But we used to just meet once in November, December, instead of every month. And I don't know if it's, Jeff, do we have to meet every month? Or would it be possible in that period of time to cut down to just one? Since it's busy for the holidays and impacts trips and vacations, just to think about.
I'd have to check our pertinent documents, but if the board wanted to change it, you could change your own policy. So I think you have flexibility if that's what you want to do. There may be some reasons why we might need to meet every month, but I defer to
Executive Director.
Doris or staff on that.
The board could, by policy, choose to not meet in certain months. That is common in some other jurisdictions. However, I do think that we probably do need to meet in both November and December because we have to receive the audit reports and then finalize the financial statements. All of those things happen, and the actuarial report at the November, December meetings. So those usually typically are fairly busy, especially the November.
Okay, just wanted to throw that out there. But then we had 3-day-long meetings, so
Yeah.
Yeah, it might depend on whether our actuary could get us items in time for October, but I think that would be a little bit of a push, quite honestly. I don't think that's quite doable at this point with our scheduling.
well, maybe we could look at this next year and see if we met, one of those 2 months, if it might work in the future.
I'm happy to look at it for 2025 and reach out to our auditors and our actuaries to see if they might be able to accommodate that schedule.
Thank you. Any further comment regarding the proposed 2024 calendar? Do we have a motion to approve said calendar? We have a motion and second. Trustee Harris and Cavness. Any further board member discussion? Any public comment?
There is no public comment.
Ms. Zeller, if you take a roll call vote, please.
Mr. Land?
Yes.
Ms. Cavness?
Aye.
Mr. Jurdy?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris? And Ms. Pierce?
Aye.
Approved.
Thank you. Our consent agenda is item number 3, and all matters on the consent agenda are approved by unanimous consent unless a member of the board wishes to pull an item for further discussion.
I move approval of the consent calendar.
Second.
I think it's unanimous consent, so I don't believe we need a motion or second.
Yeah,
But seeing no request to pull any of the items, it will be approved by unanimous consent. Item 4 is discussion regarding the Historical Benefit Review Project Status Report and Project Updates. Executive Director Rentschler.
Thank you, Chair Cromer. In this month's report, I have all of the months from past years summarized with one line, but I did leave the detail for all of 2023 so the board could see more detail as far as what was accomplished there. Only 29 accounts were corrected during 2023. Staff also identified several other corrections that were completed, but kind of on an off-cycle basis, not in our typical monthly schedule, that did not get picked up on the report when those corrections were completed. Those will be reflected on the January report. And we're trying to make steady progress on this as we move forward. I'm happy to answer any questions.
Any questions or comments from trustees regarding the report? I would just like to say that I know it's not on the agenda every month, but when it is, we try to move it towards the top so those that are interested can see it at the beginning of our meeting, and I do appreciate the update. I don't believe it requires any action. Do we have any public comment regarding item 4?
There is no public comment.
Thank you. We can consider item 4 received and filed. Brings us to item 5, discussion and possible action regarding investment matters. It appears we have some representatives from Euro-Pacific online, and there's an education session as 5A.
Trustees, that's correct. We do have some members of the Capital Group here today with us. Vincent Ortega, Client Relationship Manager, Emily Lau, Equity Investment Director, and Sue Walton, a Senior Retirement Specialist with the Capital Group. They're going to go over a brief introduction and then educational piece and a performance update at the end. Take it away.
Thanks, Robert. Can you hear me okay?
We do.
Fantastic. Also, I wanted to find out the logistics here, technology-wise. Are you able to see slides if we share those with you? Or should we just point you to the pages that we'll be
You can share the
addressing?
slides. You should be able to share your screen.
Okay, fantastic. Well, let me get started. And good morning. First of all, I want to thank the chair and the board for the continued trust and confidence placed in the Capital Group American Funds Organization. It's truly a privilege to be a part of the investment team. I also want to acknowledge Callan for their work and support. We're going to kind of switch things around a little bit, as Robert mentioned. We're going to start with the education piece first. And so with that in mind, Sue Walton's going to talk about that piece, but let me go with the introductions first. I'm going to kind of go backwards a little bit. I'm going to start with Emily Liao, who will be talking about our Euro-Pacific Growth Fund review. She's an equity investment director, 19 years of investment experience, the last 10 with Capital Group. Emily works closely with the entire international equity team, portfolio managers and analysts, so has a great understanding of the overall portfolio from top to bottom. Just a great resource, not only for us, but also for our clients. And Emily's based out of our New York office. And then Sue Walton, as I mentioned, senior retirement strategist, 25 years of investment experience. She's been with Capital for 7 years. Sue supports our public fund team and our clients, often leading discussions about fiduciary education, thought leadership, surveys, and trends that are specific to the public sector retirement plans. So Sue is based in Los Angeles, and before I turn everything over to her, I'd also like to mention, although Capital Group is obviously viewed as a partner from an investment perspective, it's also important to know that we have a tremendous amount of resources to support our clients, and that's where Sue comes in, to provide and support our clients to understand the retirement landscape, hopefully from a broader lens. So with that in mind, today's headline for the educational topic is DB and DC as complements. And I'll let Sue expand a bit more on what that really means and how her prepared remarks may be able to get you closer to understanding and what retirement landscape really looks like when you think about both defined benefit and deferred compensation. Sue, I'll go ahead and turn it over to you.
Well, thank you so much. What a great opportunity to be part of the conversation. In these very short 20-25 minutes that we're going to talk, we're going to make you retirement experts. It shouldn't take that long, right? Given the exposure that you already have. But it is a great opportunity to be part of the conversation. As Vince indicated, we've done a lot of work and research, in particular on the public funds retirement side. and really understanding as a system, how do we make sure that everything is working as successfully as possible, with a recognition that we do have very different approaches if we think about the public fund space versus, let's say, the corporate market space, and the insights and the trends that we're seeing. We have to be mindful of how appropriate those are and where we can, pick some lessons learned on the corporate side, apply them into the public fund space, and then recognizing the complexity of the public fund space in making sure that we're meeting the needs of the different constituents and members that we're trying to serve. So that being said, we are going to launch into a very brief conversation. There's a lot of material here. I am not going to cover every slide and every number on these pages, but we will be providing this information to you as well. It'll be available to you to review and dive a little deeper into. And there is a recognition that while you do not have maybe direct oversight to the deferred compensation offerings and programs that are available, having an understanding, being a participant or member yourselves, these are great insights, especially as we're thinking about, the goals that we have from a defined benefit pension plan and the opportunity that we can supplement that retirement security with deferred compensation and other benefit programs. So just wanted to highlight some of the areas that we've done a lot of research on. And one other side note, a lot of the data that we're pulling is public information or, especially on the deferred compensation side, coming from the Public Retirement Research Lab. This is a joint venture between the National Association of Government Defined Contribution Administrators, or NAGDA, and the Employee Benefit Research Institute, or EBRI. And they've created a database that Capital Group was one of the founding partners, created a database for defined contribution insights for the public fund space. So for many years, when we had these conversations, we would just be referring to corporate fund data or corporate plan data, and recognizing that there are such significant differences in these programs that having those insights from a public fund perspective has really given us a lot of insight and opportunity for conversation. So if we think about the state of defined benefit plans and the trends that we've seen over time, we do a compare and contrast relative to the corporate marketplace and relative to the numbers that you're seeing on the page. On the left-hand side, DB and DC. On the private side, you can see those gray bars are representing private industry workers that have access only to defined contribution. And the smaller bars are representing those with defined benefit and defined contribution. On the right-hand side, the very tall blue bars, these are our government workers with access to defined benefit plans. So still a very significant portion and part of the retirement security. So very different in terms of the systems in and of themselves. Now, what's been challenging even prior to 2020, we're using 2020 as kind of this point in time where we had such extreme market environment right before the pandemic, and really thinking about the trends we were already seeing in pension plan design. And if we think about the structures and the ways that we can incorporate benefits, there are factors such as what's the vesting look like? What is the retirement age? If we think about final average salary period, is that a more of a recent time frame, or do I have a longer time frame to be considering that? Cost of living adjustments. And prior to 2020 and even prior to the last couple of years, we would have thought, oh, well, that's not as big of an impact. But certainly as we're seeing inflation become much more of a factor, understanding those cost of living adjustments is going to make a difference relative to those benefits. Certainly the benefit multiplier and the employee contributions, whether or not they're mandatory, are areas that we already saw significant cuts happening. And if we think about that for the new hires only, and even to the extent it was impacting current employees. So prior to 2020, with the recognition that 2020 and beyond, since what we've seen from 2020 and beyond, challenging market environments, certainly a lot of pressure, interest rates where they are today, having a pretty significant impact on the health of programs, especially in the public fund space. And I apologize, I'm a little bit raspy today. Very cold, actually, in Chicago today. So Just keeping that in mind, I'll try to keep my voice strong here. But if we think about the impact that this has had from a public funds perspective, from a governmental agency perspective, increase in taxes, the opportunity to potentially cut benefits even more, and really this new focus to try to think about how do we complement these programs, especially in the defined contribution front. Now, we would be remiss if we didn't take an opportunity to at least take a peek at your current pension structure today. So the pension landscape for Mendocino County, we have seen those changes over time as well. So if we think about the three categories that you're representing, the general and enhanced, if we think about the safety group, as well as safety probation, these are kind of the major categories in terms of the programs that are offered. Benefit calculations are based on the date of hire as a permanent employee, the date of transfer, maybe from a non-qualifying position to membership, or date of membership prior to 1/2013 from another public retirement system. So opportunities to qualify and really think about how that benefit calculation happens. We have seen significant number of tiers. So general tiers 1 through 4, you've got general enhanced 1 and 3, safety tiers 1 through 3, and safety probation tiers as well. And really with a recognition that we've seen some changes over time. Either it be the final average salary, 1 year versus 3 year, the max COLA versus no COLA at all. So really getting into some of those tiers that are not benefiting from cost of living adjustments, and even a change in the benefit calculator or benefit calculation over time. And those percentages have an impact. So how do we think about this in context of the demographics that we're seeing in the public fund space? Recognizing in the private market, we see a lot of turnover. We see a lot of folks, not staying at jobs very long. If we look at the generations in the marketplace today, if we, go to the most extreme scenario, some of our Gen Z and millennials entering the workforce, if we think about their tenure at a job, it's pretty low. Look, millennials on average are going to be staying at at their next opportunity 12 to 18 months in the corporate space. The good news is that we do see folks staying longer in the government sector, and on average staying longer relative to the corporate marketplace. And you can see those numbers as they're represented federal, state, local versus our friends on the private side. But we want to make sure that people are really recognizing the benefits that they do have. Because if we do have vesting schedules that are outlined here, that people who are changing jobs and moving on too quickly are going to lose out on some of those benefits that maybe they want, one, they don't understand, and two, that there is some opportunity to make sure that, with tenure, that we're actually realizing the most from the vesting opportunity for their savings. So that if they're changing jobs too often, if they haven't stayed relative to the design, that they may be leaving money on the table, which further it causes a decrease in the retirement security coming from pensions. So it is a recognition that there may be some potential losses for people who are turning too quickly in their role. And certainly understanding the demographics, if you will, from a public fund space, really the differences here from safety versus civilian, recognizing that safety does have the opportunity to retire earlier. And are there some, considerations as we think about that pension plan design, the impact of the multipliers, the impact of that income replacement ratios? These are some considerations here. Now, if we add in defined contribution or deferred compensation as an additional benefit, really having that opportunity to be more inclusive in terms of that retirement security. So just thinking about the different demographics, thinking about the different plan design opportunities, and certainly the impact that that's going to have on someone who is, retiring at 55 versus 65, and thinking about what their assets are going to look like. We represent that. This illustration here is this extension of human capital. So as I'm working and in my working years, my human capital is going to decline. So it's my most potential is when I'm entering the job market into the workforce. And certainly my productivity will decline over time. Now, if I retire before that potential has been realized, I may be leaving quote unquote financial capital on the table. So it's a recognition of thinking about if I, wait longer to retire, I may not have to quote unquote unretire at a later date to, continue to fund my retirement through different sources as an example. So really just thinking about that relationship of human capital versus financial capital and the opportunity of what it looks like in retirement as I start to spend that money. So if I think about that replacement, liquid assets after 5 additional working years, my safety worker with no drop opportunity versus my safety worker with drop, you can see from that standpoint, defined contribution, additional assets in terms of that opportunity there, and taking that into consideration, just another added complexity as we think about those replacement ratios over time and the impact that that could have. So really taking advantage of things that are available, benefits that are available to our different demographics, and the recognition that active management can add value. And just by adding, and we say this all the time, that additional 50 basis points or 0.5%, the impact that that could have in terms of meaningful ability not to run out of money, you can see from that perspective, the safety worker, a safety worker after drop, the civilian worker, all will benefit, have less likelihood of running out of money by just adding that additional opportunity through active management. So a lot of opportunities for us to shore up what we're seeing on the defined benefit side, and thinking about how to complement that in terms of the deferred compensation approach. So we thought it would just be helpful just to hit a few highlights, knowing that you are not directly responsible, but certainly may at some point in time have the opportunity to opine. One of the areas that we're seeing as an evolution for success from a member's perspective is really not just thinking only about saving. So get them participating in the the 457 plans, get them saving at higher rates, but also this consideration of what happens after retirement or post-retirement, that recognizing that people will continue to need to stay invested, just given the long time horizon that they have, if it's 55 or 65, that it's a recognition that there's a long time between now and that sort of terminal date to make sure that we're not running out of money. Now, how do we think about that in terms of this complexity? A lot of additional opportunities on this front, 457, 401A, 403B, and some may even have some exposure to 401Ks. We recognize from our public retirement research lab data that we've collected over 116 government plans. You can see representing 2.3 million participants. We're going to be refreshing this data, and every year we're adding new data to the program so that we can start looking at different trends. And we could even, really look at that data as, your county versus other counties as an example, if we wanted to do some benchmarking from that standpoint. So thinking about the kinds of participants where they are invested, the majority of our public funds are in the 457B plans and assets as well. So not surprising given that. And how do we take advantage of different factors to enhance these programs? We would say there's probably a top 3. Plan design is the top of the list. The second, investment structure and the strength of those investments. And third is probably looking like that engagement. How are we communicating and educating our participants and helping them take better action? Now, we recognize that from a public funds perspective, we are a bit limited if we think about automatic enrollment and automatic plan designs, which the corporate side of the house has benefited pretty tremendously from over time. And looking in the state of California, that some may, no automatic enrollment legally prohibited unless it has been negotiated. So really thinking about those opportunities, unless I have that wrong in terms of the color scheme, I think that's right. But thinking about that in the context of what's allowed and what's available, and can we take advantage of other opportunities like active choice or quick enrolling, making it very simple for people to get into the plan, combining annual benefits enrollment with this conversation around retirement, around the 457, considering an employer match. So these are design features that could help encourage people to get into the plan, to be saving more as a complement to their pension opportunities. So, of course, we say from a plan design feature, make sure that we review all state and local laws, collective bargaining agreements. We know from NAGDA, so the broader survey itself, only 18% of folks are using auto enrollment and 33% are using auto escalation. And some are considering this idea around an investment re-enrollment to get people in the right place. So really thinking about a number of different strategies to engage and to get people to take more action. If we think about that from a menu design, less is more, even on a supplemental basis. We've seen on average about 21 funds being offered across the board, and you can see how they're allocated. So considering, too many funds, that people won't make good decisions. And for the most part, people are taking advantage of things like target date funds as a simple one-stop shop for some of our participants. And you can see from the data, we're across the board, some pretty heavy concentration in asset classes like large cap domestic equity, stable value, some international, and certainly target date funds on the rise relative to those allocations and offered relative to participants. So more to come with regard to investment structure, but I think the guiding principle here is less is more. And we can think about that in the context of how to help people make better choices. If we think about an ideal structure, it probably looks something similar. Going back. Similar to target date funds or some asset allocation fund, a core menu, so 3 to 4 options on the equity side, US equity side, 1 or 2 options on international, maybe a couple options in fixed income, and certainly some preservation or money market fund to balance out the considerations. And like I said, we are seeing a lot of folks think about what happens post-retirement, recognizing that our defined benefit plans are contracting in terms of their benefits, like the overall benefits available, that replacement ratio that's going to be kind of ideal for somebody in a pension plan has declined over time. And we know we've got a shift in participant demographics. They're aging. We've got an aging population. We know Secure 2.0 has had an impact in terms of both plan design as well as keeping people in plans longer. And plan sponsors are recognizing that there might be an opportunity to consider what happens post-retirement. One of the areas that we've been working a lot with some of our public fund clients is this idea around income replacement. If we think about retirement income, if I take into consideration both my defined benefit plan and my 457 or deferred compensation programs, what do my participants, what does it really look like in terms of their retirement security? We've run this study both for a couple of our county clients and really cutting it both from a safety as well as a civilian standpoint and understanding. So this particular client had a very aggressive goal to say, I'd love to see the majority of my participants achieving 85% income replacement. And that's going to be coming from defined benefit and deferred compensation. And if we do the study, who's falling behind? Who do we need to focus on from a demographics perspective? And you can see on the safety side, more often than not, especially for those that were, the safety opportunities here, higher percentage in terms of that, achieving that 85%. It was lower on the civilian side. So really an opportunity here to be thinking about that plan design, thinking about those compensation structures. and just really just putting some information out there for the trustees to be thinking about as they're, going through their decision-making process. So just something to think about. And again, really bringing together this idea of how these programs work together to provide for that retirement income security. And some things we're going to throw out there that just to keep in mind, we are seeing those different generations in the marketplace today. They have different attitudes, they have different perspectives. How do we make sure that we're, meeting them where they are in terms of the plan design and the retirement benefits, but also from an engagement standpoint, what's the best way to connect with them? Communication is only effective if they are listening. And how do we get in front of these folks to really create that opportunity? And we know from different populations that there are times that these messages are not being sent when they're ready and available, that they're receptive to receive that information. So it's figuring out too and working with your plan administrators and others to make sure that we're connecting with them at the right time. And certainly not surprising, especially in the public fund space, this idea of health and wealth coming together. I know there are a number of programs that are thinking about retiree healthcare, so retirement accounts. And certainly from a more corporate perspective, this idea around health savings accounts in combination with high deductible plans. It's really this thinking about these things together with a recognition that a significant portion of our retirement spend is going to be for medical issues. So I've covered a lot in a short amount of time. I will pause there. I will stop sharing and open the floor to potentially any questions that folks might have.
Trustee Jurdy.
Okay, so you did cover an awful lot of material there. So to go into some of it, you talked about the advantage of gaining an extra 50 basis points in returns. And the way you couched it was through active management, and some people think that's possible. Others think it's largely not possible over a long period of time. But I did want to point out that for our plan members here in Mendocino County, in 2013, when I became a county supervisor, the cheapest index fund that the county of Mendocino offered its employees through the 457 plan was 119 basis points. Today, it's 26 basis points. So we've reduced it by 93 basis points. So that definitely improved their performance over the investment, and that was again for the U.S. Stock market. So so reducing fees is the only way to guarantee improved returns. You can hope to get better returns through active management, but there's no guarantee with that. And then the second thing is, you pointed out the chart of the United States showing that in California, it requires negotiation with and approval by the bargaining groups in order to have automatic enrollment. I think that the Board of Supervisors would believe it's in the best interest of the employees to have automatic enrollment, because what we've seen is that with employers, public and private, but let's talk about public employees, that when you have automatic enrollment, most employees won't bother to disenroll. And so as what I've seen is that typically the investment companies, in our case it's CalPERS, they want to see some sort of minimum contribution per pay period. Otherwise, there's a fair amount of paperwork on their behalf to deal with someone putting in $10 a pay period, let's say. So I don't know what their minimum is. It might be $25 a pay period, something relatively small. But in my mind, it's in the best interest of the employees if the county did have automatic enrollment, even if it's a really tiny token amount. And so I don't know, but I think that it's probably within the purview of this board to recommend to the employee groups and to the county government that we have automatic enrollment. Again, the bargaining groups would have to agree to it. I don't know why they wouldn't, because it is in their best interest, considering that a majority, I think at this point, it's over 60% of our employees are in the PAFR plan, as I am, which has no COLA in retirement. And so it's that much more important that new hires to the county would be automatically enrolled into the deferred compensation plan to at least put something into their savings. And then finally, my question is, when you've seen an escalator, you made some quick reference to it, how might that be structured? So I know IT at our county is improving, but there's still a lot of PDFs circulating. I just turned in one today with my 457 plan, you know, there's not everything is automated as it is with other public agencies. So for example, state of California, an employee can log in online and amend their monthly contribution into the 457 or 401k plan. County of Mendocino, it's still done with PDFs you print out and you hand to somebody. But how would that automatic escalation, how might that work? Might it be so typically an employee in most years is going to get a 5% increase based on merit, you know, for 5 steps. At some point they reach step 5 and they don't get those anymore unless they get a new job. And then they also get typically some kind of COLA. Would the escalation for a 457 plan work something to the effect that, you know, if I'm contributing X and my salary increases by Y, my contribution, I could choose to elect to increase my contribution by the same percentage as my salary increased? You know, so in other words, if your contribution, if your salary increased by $100 a pay period and you were contributing 1% of your pay, might it also be 1% of the salary increase? I'm not sure how they normally structure those automatic escalators that would be an option for the employee.
Yeah, let me start with the auto escalation first, because I think that's probably the easiest question of all your comments to address. The auto features are done through the administrator of the record keeper. So, and I apologize, I don't, maybe Vince knows off the top of his head if it's Empower or Foyer, Fidelity, or whoever the record keeper is. The auto enrollment would be a set rate. So we typically see in the public fund side 3% as kind of that good starting point for folks to get involved. And it addresses kind of your point of it shouldn't be too little because these are small little pieces, but it shouldn't be too much because then it overwhelms the participant. So typically anywhere between 3 and 6% are those auto enrollment. It's all done at the record keeper level. The only interaction that the participant would have is to fill out that form to say, I'm opting out. Like, I'm not doing that, or changing it to a different level. The same on the auto escalation. If I'm doing auto enrollment at 3% and I'm doing auto escalation, it would be done increased on an annual basis. And most clients will do that 1% every year. So if I'm starting at 3% auto enrolled, next year it's going to be 4%, and the following year 5%. And they typically do this up to a cap, and most plans are doing that up to a cap of 10%. Some of our corporate friends are just saying no cap, let the IRS decide when I've hit that limit. So there are obviously different mentalities in terms of that structure. On the private side, we don't have defined benefit to fall back on, so I need people to be saving as much as possible in their defined contribution plan. On our public side, let's just make it tolerable, right? Let's continue to increase, because we know most people will not opt out. So whatever we put as a format and a structure, people will follow. So thank you for the comments around active management. We know that not everyone can achieve that. And certainly there are areas of the marketplace that are much more efficient than others. And then you've got organizations that have been very successful over long time periods on a net of fees basis to be able to add that value. So it is on the onus of your consultant, your advisors, to be helping you identify those particular opportunities, as well as areas of focus. International equity, as an example, I think has long been known as an area that active management has proven to add value more often than not. Fixed income would be the same. So there are certainly areas of the marketplace. We're not saying it's a guarantee, but when we have that opportunity, it really has a tremendous impact. So how do we, kind of this change of focus in thinking about it's less so in terms of and public versus corporate. Certainly on the corporate side, there's a lot of ERISA and fiduciary conversations that happen and decisions that are made relative to that context, the sphere of litigation. That shift of focus, even in the corporate space, has been less on a drive to zero from a fee perspective. And now we're seeing lawsuits and litigation around outcomes. I could have had a better outcome. I could have had that additional 50 to 100 basis points. I would have had more saved for retirement had we had more exposure to active management. That is what we're seeing in the marketplace today. So while I'm not saying it's a total mind shift, we are seeing a bit of a shift of focus in terms of outcomes.
So the other
So
thing,
thank you for your comments.
yeah, the other thing I want to comment is I also appreciate the fact that your presentation at least touched on the retirement income that public employees have in the form of their pension. In the case of Mendocino County, because we're talking to the Mendocino County Retirement Association, the county employees have both have their public pension and they also have Social Security. And what I think is interesting is when you, most of the conversation in the public, whether it's through podcasts or articles, they have to do with a defined contribution plan and Social Security, but they don't also talk to an audience generally that also has a pension. And because the pension is so significant for anyone who's worked 10 or more years in a public employment, you know, it is a very significant share of someone's retirement income. And I think it does change the way someone might consider investing their investments, because they don't need to be as scared about volatility, or at least for all of their investments, as someone who has only Social Security, which might only be 30 to 40% of income replacement. But a county employee is going to have 30 to 40% through Social Security. And when I say 30, it's if they claim it early, it's about 40 if they claim it at age 70. And then they're also going to have a public pension of some amount, some varying amount, depending on the length of time they worked, their salary they earned. And so their investments don't need to provide, say, 30 or 40% of income replacement. Their investments only need to earn maybe 10 or 15%. And they also have other strategies at their disposal. They could claim retirement, claim Social Security early, and barely touch their investments, or they could postpone collection of their pension to get the full guaranteed amount. They could postpone Social Security till age 70 to get the maximum amount, inflation protected forever, and look at spending down some of their investments in those gap years between retirement and age 70. When they collect Social Security, if they want to defer Social Security to age 70. So I'm saying there's all sorts of strategies that is rarely discussed in the media about retirement that I think is specific to public employees.
Well, we appreciate that. That's been our focus for the last number of years now, with a recognition that these programs are much more complex, but there are a lot of really great opportunities. And another area that you didn't mention that we ran through very quickly on the safety side is drop. So taking that as a strategy as well. So lots of opportunities and more to come. We have just really started in the last couple of years our focus on this research. And now, because we are getting more of these insights, like from the Public Retirement Research Lab, that we're just getting started. So we appreciate the feedback and the conversation today. I think I have, maybe overdone my time here. So I'll pause there. If there are no other questions, I'll turn it back to Vince.
Our Executive Director, go ahead.
I just had one quick question. Do you find that the investment option for entities that use auto enrollment is now a target date fund due to the past litigation over choosing like a stable value that was deemed too conservative over time? I just wondered if that's where it's moved to, is like a target date option.
That is correct. We conducted an institutional plan sponsor survey last year, including both corporate and public funds, and 95% of those with a designated qualified default investment alternative chose target date funds. And there's a lot of reasons for that. So absolutely.
Any question?
Vice Chair.
Thank you. I was interested in a little background on your chart on page 14. The odds of not running out of money at 95. Do these calculations include folks that end up in assisted living or rest homes or things like that?
I think, I don't know that it got to be that specific. I'd have to go back and check the assumptions, but I think there were more broader assumptions relative to that.
those drive up people's cost of living four
For
and
sure.
five-fold on a monthly
Yeah.
basis, so it'd be nice to know. Thank you.
I had a quick question, and that was in regards to the selection of Roth contributions versus non-Roth. I didn't see that come up anywhere in the presentation. I personally made a big mistake a long time ago choosing too much in the non-Roth, and I believe that would really encouraging people to invest in the Roth aspect will really help in the end, especially with not running out of money, not paying ridiculous amounts of taxes at the end.
No, I totally agree. There are opportunities from a diversification standpoint. We certainly have legislation, Secure 2.0, that was making mandatory, especially on the catch-up contributions, to be Roth only. Now we've got, that was supposed to happen in 2024. Administratively, that is very challenging. And luckily, they have pushed that out now to 2026. So I think that is yet another opportunity from a complexity standpoint, from a diversification standpoint, that we really have an opportunity to share with folks how they can be thinking about that tax benefit, either the pre-tax versus the Roth selections as well. So absolutely, we're happy to pull some data on the public funds to show who does have the Roth versus the traditional approaches, and share that data back with you.
I believe the only comment I had, or I guess it could be a question, is I believe Mendocino County currently has 2 opportunities for deferred compensation, and if there's an automatic enrollment, how would it be designated as to which company is utilized? I don't know.
Hopefully the CalPERS plan, because it has much lower fees.
Yeah. Well, I know that I am not in that plan, and it's changed ownership at least 3 times in my tenure with the county, and it's sort of a surprise every time it's renegotiated or sold or changes hands. So I know that would be a concern for some people. Any other questions or comments?
Yeah.
I believe we're ready to move on. Thank you.
Thank you so much. Appreciate the time.
So you want to go ahead and see if you can pull up the deck for UPAC, please. And as we get started, as we start to transition over to the UPAC review, I introduced Emily earlier. I failed to introduce myself. I'm Vince Ortega. I've been with Capital Group for 32 years. I work exclusively with public fund plans and am the relationship manager for Mendocino County. So again, thank you for the opportunity to give you an update on the Euro-Pacific Growth Fund. Sue, if I could maybe just have you turn to page 4. We'll start there before I hand everything over to Emily. And page 4. So actually, let me actually just go one page back, page 3, if you don't mind, and just quickly give you the roadmap for today's prepared remarks. Brief organizational update. We'll talk about the strategy. I know a few of you are new. It's been a while since we've had a portfolio review. I top of my head, I think I want to say close to 8 or 9 years since in the San Francisco office for Callan. So we'll use this as a roadmap. Emily will talk about the strategy, talk about markets overview. I'm sure you've probably heard a lot about the markets in general, so we won't spend too much time there, but we will spend a lot of time with results and the composition of the fund and the attribution that led to those results. And then we'll end off with a brief outlook of international markets. So Sue, if I can have you turn to page 4, thank you. There's just a couple of things I want to highlight here in terms of the capital organization. We're global, research-driven investment management firm. As you can see, $2.3 trillion in equity and fixed income assets on behalf of our clients. I think that one area that I really want to stress here on this page is the notion of Capital Group being privately held. This is critically important because it not only allows us to manage our portfolios but also to manage our business that are in the best interest of our clients without the distractions that you would typically find with a publicly held firm. In addition to that, as a privately held organization, been in the business since 1931, extremely strong balance sheet. We don't hold any debt. So what this allows us to do is really to invest and reinvest in our business to meet the needs of our clients. The point here, I think, really is organizational stability, focus, and commitment specific to our clients. The one other thing I want to bring out on this page here is the, what you see here is the multiple manager team. And this is basically our approach to how we manage money. It's a multi-manager approach. We have 12 portfolio managers on this particular fund, each making independent investment decisions within their respective areas of and style of investing. You'll also see, it'll be important to note also that the analysts, our team of research analysts, not only meet with companies and provide that analysis to portfolio managers, but they are also investors as well, investing in their highest conviction ideas within their respective sector or industry. I would note that this is actually a very significant differentiator that you will not find with other investment management firms. Analysts manage money based on their success. That's how they're paid, similar to how our portfolio managers are compensated. And it's through this system that our team takes advantage of this fundamental bottom-up research, investing for the long term with a vision of investment success over 3 to 5 year time horizon, which eliminates those short-term tendencies which you can oftentimes find detrimental to portfolio construction. So I would just say that the key takeaways here is that the capital organization that's built to last has an investment process that's proven, repeatable, and time-tested through a number of different types of market cycles and environments. Sue, if I can have you turn to page 11. And I'll go ahead and hand it over to Emily to do a brief refresh on the Euro-Pacific Growth Fund and what this strategy is really designed to do for our clients.
Thanks, Vince. Fantastic. And I'll echo Vince and thank the chair and the board, for the investment partnership and for the confidence that you've had in the Euro-Pacific growth team. It's not something we take lightly, and we really appreciate the partnership here. So as Vince mentioned, I think it's been quite a number of years since we've had a portfolio review. And even when I'm meeting with clients who, meet regularly with me about this particular strategy, I often find it useful to really level set in terms of defining how we approach the international markets in this particular strategy to really create a little bit of a framework and set the stage for the conversation around the market environment that we found ourselves in, the positioning in the portfolio, and sort of expectations and outlook for the portfolio on a go-forward basis. The strategy and focus page that you have in front of you really lays out here what it is that we are doing in this particular strategy. When I talk about Euro-Pacific growth, I talk to clients about the fact that this is a very flexible international fund, right? It is a fund that has an extremely broad investment mandate. What do I mean by that? What do I mean by it has a very broad and flexible investment mandate? This is a strategy where portfolio managers and analysts, as Vince mentioned, analysts at Capital manage money, are empowered to look across the entire investment universe outside of the US to find the best opportunities for capital appreciation for our clients. So this includes looking at a number of different types of companies. So it can be businesses that are, yes, secular growers or exposed to some sort of long-term secular growth trend. It can also be investing in steady Eddie type businesses, some cyclicals at various points in
in time. It can also mean that we can invest in some turnarounds where there is maybe a visible catalyst to change the prospects or the earnings momentum for that particular company. So there is a wide variety in terms of the ways that we approach this investment objective of long-term growth of capital or capital appreciation. And there is wide latitude in this particular strategy to look at companies everywhere outside of the US. And that's important because we can invest in this portfolio in companies that are domiciled in the developed markets outside of the US, so European businesses, Japanese businesses, but we also do have a lot of flexibility to invest in companies domiciled in emerging markets. So we can invest in companies in India, in Brazil, in South Africa, even in China. And obviously this has been an area of the market that has generated quite a bit of discussion, debate, and has also been quite a bit of drag on the international markets if you look at them over the course of the last 10 years. So we can talk a little bit about what the opportunity set in some of these areas of the world actually looks like today. So that's the framework for thinking about the broad strategy. I guess the other thing that I would sort of highlight to you about the breadth and the flexibility in the strategy, and I'll kind of tie this back to some of Sue's comments about the fact that, in international markets, this has been a place where active management, and in particular this strategy, has been able to add quite a bit of value. She referenced that sort of 50 basis points of alpha in terms of increasing the likeliness or decreasing the likelihood that people would have shortfalls in terms of their portfolios in retirement. And when you look at this particular portfolio, we're aiming to deliver total returns that exceed the ACWX international markets over full market cycles. And when you look at the results of this strategy, the consistency of the strategy over time, what you'll see is we have an extremely high success ratio at being able to generate that excess return over those long time periods. It's about 99% of the time if you look at rolling 10-year periods since the inception of the strategy back in 1984. So that is quite a high degree of success. I know people talk a lot about how maybe active managers in various or other markets haven't been able to generate or consistently generate alpha, but this is a strategy where we have been able to consistently generate alpha for our clients over those long time horizons. So that's the broad strategy in terms of the investment approach, how we think about the opportunity set. Let me move to a little bit of a comment in terms of the broad market, because there are some interesting dynamics going on in the international markets today, and there is quite a bit of contrast today in terms of what's gone on in the international markets, even relative to what's gone on in the U.S. market, where it seems like all everyone ever wants to talk about is the Magnificent Seven and a very narrow and concentrated set of companies driving the market. It is a very different market outside of the U.S., and I think that has a lot of implications for how to think about approaching these markets today. So Sue, if you wouldn't mind, page 14 of this presentation gives you an overview of the markets in the first 9 months of the year. Now, I will sort of run you through actually yesterday, because the international markets, very similar to the US markets, have actually been quite volatile this year. And there's been quite a bit of volatility between the months of August and November, where markets were down quite sharply. Markets have obviously rebounded in the month of November and now here into December. And as we approach the end of the year, some of these numbers are quite old in terms of the market. But let me just sort of explain to you what went on in the market in the first 9 months of the year and sort of catch you up a little bit here. Essentially, what you had in the international markets here is you had a very strong first half of 2023. So the market was rebounding and rallying from a very difficult 2022. If you remember, the market was down very sharply and was reflecting a lot of pessimism about the impact of very aggressive tightening on the part of central banks globally. It was a market that was very downbeat about economic activity, in large part outside of the US due to the war, Russia's invasion of the Ukraine, and also because you had throughout 2022 a Chinese economy that was virtually shut down. So a lot of those things conspired to cause a very difficult market environment in 2022. Now you sort of get to the end of 2022 and the market starts to rally. And the market starts to rally, and it rallies pretty meaningfully because people start to think, well, central banks have really got their hands around inflation, and maybe we're headed to the end of a rate hiking cycle, and maybe we might see some rate cuts next year, and that'll be a good environment for growth and growth-oriented securities. They were also saying things like, wow, the Chinese government made a extremely sharp pivot with respect to the COVID-19 lockdowns. The economy has reopened, and we're expecting that the Chinese consumers, very similar to the US and the European consumers, when they emerged from pandemic lockdowns, were going to go out and they were going to spend. And that was going to fuel that economy as well. So that was the first half of the year. It was reflecting a lot of this optimism. Then we moved to the third quarter, which was quite difficult because what happened in the market in the third quarter is we had a very dramatic rise in yields, and we had very dramatic movement in yields. And a lot of that was because people looked at the US economy, which was proving to be quite a bit more resilient than they had been expecting. And they had said maybe the central bank maybe the Fed is not done raising interest rates. And they looked at conditions, macroeconomic conditions outside of the US, and they started to see some deterioration. And they said things outside of the US look quite a bit worse than they do in the US. And that dynamic caused a pretty big sell-off in the market, a rally basically in energy and a sell-off in the broader market. Now, if we sort of fast forward here, I'll give you the updated numbers. If you look just on the quarter to date here in the fourth quarter, the broad market, the ACWX, is up about 4.7%. So now on a year-to-date basis, the ACWX is up about 10.4%. So it actually has been, you've had quite a bit of a rebound in the market environment, and you've had a pretty good year in terms of the international markets. Just one other thing that I would a couple of other things that I would highlight about the non-US markets. Obviously I mentioned emerging markets have been very weak. That's been a product of a Chinese economy and a Chinese market that has been very, very weak this year because there is a lot of pessimism about the economy, about the property market, about regulation, about the geopolitical environment. But you also have had some big bright spots in international markets. If you look on the right-hand side of your page, you can look at the Japanese equity market, especially in local currency terms, where without much fanfare, this has been the best returning developed market globally this year, in large part because there are a number of structural reforms going on in that country in terms of corporate governance reform, inflation, a country that didn't have any inflation for the better part of 30 years, seeing some hints of inflation, which are, fueling some optimism that you could get a pickup in domestic consumption in the country. So there are some bright spots here in the international markets that we should point out. The other thing that I would highlight, so if you wouldn't mind going to the following page, and it's a little hard to see here, there's a lot of numbers on this page, but if you look at the right-hand side of the page, if we were looking at this chart, and it's the returns for various sectors in the market, if we were looking at this for the US market, you'd basically have huge bars for information technology, consumer discretionary, and communication services, right? All of the AI-driven tech and tech-adjacent type companies. Very strong returns, and the rest of the market basically flattered down. So in the US market, it's been very narrow and concentrated. What you can see on this chart is that you've had strength in some of the tech and tech-oriented areas of the market outside of the US, but you've also had strength in some of the more cyclical areas of the market. Energy, industrials have been strong outside of the US, even financials. Despite the fact that you had a banking crisis in the US, the financials and the banks outside of the US have really benefited from the higher interest rate environment and what that's done to their earnings. So it's been pretty broad-based and diversified in terms of the gains in the market outside of the US. So that is the broad market overview. Now, if we turn, we have both results for the portfolio through the end of September, but also through the end of October, which includes the very difficult month of October, where markets were down very sharply. But if you turn to page 17 and you're looking at the results, we're going to talk through sort of the year-to-date results where, as I mentioned, if you were looking at this very volatile market environment, we were at the end of the third quarter slightly behind the ACWX in terms of our returns. Now, if we fast forward through yesterday, we are now year-to-date up about 11.2%. So we are now 80 basis points ahead of what has been a rebound in the market on a year-to-date basis. So that number has changed in terms of the dynamic and because of the volatility in the market. But we should focus on that 3-year period as well, because this is where we do have some challenge results, and we should not overlook the fact that on a 3-year basis, we have not been able to differentiate ourselves here in terms of excess return generation. Now, 5, 7, 10 years, we still have quite good results and ability, or have had generated a lot of alpha in the portfolios, but that 3-year number has been quite challenged. And I would just highlight the fact that we have been in an environment that has seen some very dramatic moves here in interest rates and in the inflationary environment, and that has driven some very, very big sell-offs in some of the higher valuation growthier areas of the market. And this has been a portfolio, if you looked at the course of the last 3 to 5 years, that has had more of a growth orientation. So those sharp periods where growth has sold off because of some of those dramatic moves in rates and yields has been quite difficult for us. So we should acknowledge that, but I would also talk a little bit about how we're thinking about positioning the portfolio given some of the challenges that we have on that 3-year period. So that's kind of the shape of shape of the results pattern here. Now, I'll make a couple of very high-level comments on the attribution, what was kind of helping us and hurting us in this environment. So if you wouldn't mind going to page 19, this is a page that has a ton of numbers, and I am not going to run you through all of these numbers, but I'll hit you with just a couple of the high points in terms of attribution. If you're looking at the bottom left-hand part of the page, this is attribution by sector, and it's telling you where we're sort of adding value and where we've had some challenges in terms of the stock selection in various markets. If you look at the portfolio, one of the biggest drags in the portfolio on a year-to-date basis has been financials. I mentioned outside of the US, the banks in particular, the European and the Japanese banks have actually benefited in terms of earnings because you have, higher interest rates have helped net interest income and have boosted bank earnings. We do not have a lot of exposure. We have not had a lot of investments in these portfolios in the European and the Japanese banks. And I think even today, when you look at the macroeconomic conditions outside of the US, they have been deteriorating. That does not appear in, sort of over a 3 to 5 year basis for us to be an attractive opportunity set. Now, there are some company specific opportunities there, but generally speaking, it's been an area where we have had less exposure, and that's hurt us. We've also had, we still have very low cash in the portfolio. It's not like we have any lack of investment ideas, but any cash in an up market is going to be a little bit of a drag on this portfolio. Where we have had some good investments and what's helped us and helped support the portfolio in this environment, some of the investments that we have in the portfolio in technology. We have really emphasized in this particular portfolio some of the semiconductor and semiconductor equipment companies. If you think about AI, you can think that, the future of artificial intelligence, the future of connectivity is really dependent on leading edge chip technology. So companies that are enabling the production of leading edge chips are an area of focus for us. That includes companies like ASML, to a lesser extent TSMC, but also on the memory side, SK Hynix as well. The other area is industrials. In industrials, we have been making in this portfolio some very large statements in terms of the aerospace and defense companies. I think if you are optimistic about the resumption of air travel back to pre-COVID levels, and air travel has been very strong, you're optimistic about, sort of the 9 or 10-year backlog of orders that a lot of the commercial aerospace companies have in terms of their order books. These look like this looks like a pretty good setup for some really, really strong secular growth opportunities. And then the last one that I will just highlight, because it is the largest contributor to the excess return in this portfolio, is Novo Nordisk. I think everyone, if they weren't talking about AI in 2023, the other thing they were talking about was the potential impact on the healthcare system, on the food companies, on the beverage companies from this whole notion of GLP-1s, right? The use of some of these drugs that had historically been used to treat diabetes to now be used to help with chronic metabolic disease. So help to help people lose weight. And obviously, there's a number of different kind of indications and also benefits, health benefits, kidney disease, cardiovascular disease that have been linked to the weight loss induced by the use of these drugs. And obviously, that's helped to fuel the share price gains for companies like Novo Nordisk. So that's the attribution. Maybe we'll move a little bit, and I'll make some comments on the broader portfolio and how we're thinking about this going forward, and then we can take a couple of questions. Page 22, I'll bring us to maybe the sector page. And look and talk a little bit about the exposures in this portfolio. And I think if we were talking about, as I sort of mentioned, the last 5 years or 8 years, if you looked at this portfolio, I think it really did have a very strong growth orientation, a strong growth tilt. And I think that was it was good in this portfolio and it had served us well because we had been in an environment where we had very low interest rates, we had very low inflation, and we had, when growth was scarce, people were willing to pay higher prices for growth, even growth that was farther out into the future. Now, when you look at the portfolio today, I think it does reflect the fact that we are in a changed environment in terms of the investment landscape, in terms of some of those things that have underpinned the market in the last 10 years, right? The interest rates are not zero and they're not negative anymore, right? Money isn't free, the cost of capital is higher, and those things change the way we think about companies and the way you have to value companies. We also have a different inflationary environment. So the inflationary environment is quite different. And the final piece of this is we are in a much different geopolitical environment. Right, we've had a number of different geopolitical events, whether it's Russia's invasion of the Ukraine, the more recent events in the Middle East, and just broadly more decoupling from China that have changed the way that people have thought about some of the investment opportunities. Because when you get decoupling from China, when you have relocation of supply chains, when you have what some people might want to call deglobalization, I like to call it reglobalization, that has and provides different opportunities for different types of companies. So today, when you look at the portfolio, I think it is much more reflective of the fact that there is a broader set of opportunities here today, given those big three changes that I talked about: interest rates, inflation, and the geopolitical environment. So the portfolio, I think, is a bit more balanced today across, still some of the enablers of secular growth in the technology space, some of the consumer discretionary companies, but you do also have some of the more higher quality growth cyclicals in the business, in the portfolio. So more investments in places like energy and materials in the portfolio, a lot more investments in the industrial sector. So I think in this environment where the investment environment is incredibly complex, and where I think that we could be in for a period of time where global economic activity could be a little bit more tepid in the near term, we're trying to be as diversified and as idiosyncratic as we can in this particular portfolio. So that kind of concludes my comments in terms of the broad portfolio, but more than happy to take questions if there are any about the portfolio, the market environment, and how we think about investment opportunities in the portfolio given those dynamics.
Trustee Jurdy.
So for clarification, so I'm looking at the performance returns, and it looks like it's 10 years, 7 years, 5 years as of the end of October of 2023. Is that how you're calculating it?
The returns you see there are, yes, through the end of October 2023.
Oh, I'm sorry. So you're on page 18?
If you're on page 8, yeah, on the top part of the page, we'll give you the, period end, October 31st, 2023.
And then just to make sure I'm getting the lingo correctly, so would you call that the CAGR, the compounded aggregate growth rate?
Yeah, the compound annualized growth rate. So annualized growth rates would be the CAGR on the 3, 5, 7, and 10-year periods, correct? And then cumulative is obviously 3 months and year to date.
I just typed into Portfolio Visualizer to look at the performance of 2 index funds by Vanguard that are low cost. And so typing in the Vanguard International Dividend Appreciation, so it's not necessarily the highest dividend yielding companies, but it's a sort of a screen for profitability of a long-term profitability of a company.
Sure. Mm-hmm.
And it had a CAGR of 6.22 over the 7-year period. It didn't exist. It's not quite 10 years old, so it doesn't have 10-year returns, but it does have 7 and less. So 7 is better than looking at a 3 or a 1-year return for sure, is to look at the longest returns possible. And the reason why I'm kind of looking at a fund like that is, I kind of go to the Warren Buffett quote of, let's see, the rule number 1 is never lose money. Rule number 2 is never forget rule number 1. And so that has to do with the idea that making sure that you're preserving your capital when you make an investment, that you're not looking for risks. And there's all sorts of risks out there, obviously. One risk in international investments that doesn't exist with U.S. is currency risk. So if other currencies, which we've seen in recent years, have seen their currency lose value in relation to the U.S. dollar, that's been a headwind against bringing in returns from international investments. Even if those companies were profitable, if their currency is worth less, it's harder for the U.S. investor to see an appreciation of their investment. And keeping that in mind, I then go to one of the longtime columnists at Morningstar, John Reckenthaler, who talks maybe a little bit about that currency risk, but in maybe a more indirect way. And he has a column in October of this year giving an update on a column he wrote 10 years prior, which was about kind of the way he kind of characterized it was the honesty of the governments that the company is based in. So, we might look at it a little less colloquially than honesty, but you might say that some governments have a longer tradition, a stronger tradition of a legal system and protecting the rights of their citizens and companies, but he kind of characterized it again as an honesty index. And then he makes a link to some association that's, indexing every country, or 150 countries anyway, based on the perceived honesty of those governments. And he made the case 10 years ago, updated again this year, making the case that countries with this higher honesty index have over time proven to have higher returns, maybe because there's less graft, there's less, and what we saw recently with China, people are saying, I'm shocked. The government took some profits from these Chinese companies that the investors thought they owned. And yet there's been this sort of academic research and this analysis that's been floating through the investment ether for some time, that maybe pursuing growth in international investments, growing economies, isn't necessarily the only thing to be looking at. Preserving that investment through investing in countries that have high levels of a strong legal system, high honesty, and less graft, that maybe that's also needs to be factored in pretty heavily into international investments. And so I realize you're not an index fund, you're actively managed, but all the more reason to think that, well, you'll be outsmarting the indexes. You'll not put money into a fund that into a company in a country that could just abscond with, you know, a sizable share of the profits of that country that the investors thought they had. And i.e., I think Alibaba might have been one of those in China. So anyway, so with all that, what's the thought of your company and your investment fund on that kind of thinking, that preservation of capital through understanding, you know, the risks of investments in different countries, either due to currency risks or due to the country seizing assets of companies that the investors thought they owned? You know, how are you adapting and anticipating that prior to the taking of those profits?
Yeah, so there's a lot, I think a lot to unpack there in terms of your questions and maybe I'll start with sort of the currency question first. And you're right that international investing, whether that is actively managed or passively managed, is, as a US dollar-based investor, you are subject to the impact of currency appreciation or depreciation on your investment. Now, if you look at the last, it's been nearly 15 years now, we have been in a US dollar bull market, right? We have been in a period of time where the US dollar has appreciated very meaningfully versus the yen, the euro, the pound. And that has been quite a challenge for, you know, for US dollar-based investors in international markets, whether you're doing it actively managed or whether you are using a passive investment. Now, how do we think about currency in the context of the companies that we invest in? So, you know, it's not just a, you know, kind of a translation effect, but obviously you have to think about this at the company specific level, because all of companies, international companies, have different cost structures. They also have different end markets that they sell into. So let me give you an example. You can look at some Japanese companies, big global exporters, and you have a lot of big exporters in Japan. Japanese companies that sell their products in dollars, there's a lot of them, and they have their cost structures in yen. Now, when the yen is depreciating, which it has been, and it has depreciated very meaningfully this year, that is a huge boost to earnings for a Japanese company if they are selling in dollars and their cost structures are in yen. So we have to think about the potential returns for these companies and the earnings given where individual companies have their cost structures, have their kind of footprint in terms of sales and what the currencies that they're dealing with are. So for us as bottom-up fundamental managers, being able to make that calculation and understand, really understand not only those dynamics, but also we have to remember individual companies also hedge on their own. So they will hedge their currency exposure. So understanding those hedges as well is something where I think that people can add a lot of value doing the bottom-up fundamental work that we do as active managers. So that's the currency question. And then the other thing I would say about the currency question, because currency has been a huge headwind to international investors over the course of the last almost 15 years. I think if you talk to almost any person in the market today, they would tell you that on almost any metric, the US dollar does tend to look overvalued. And it's very difficult to call turning points in terms of currency, but I would say if you looked at valuation, and if you looked at the fact that when you start to see turns in these currency cycles, they tend to be self-fulfilling and they tend to be long-lasting. So if you do get any turn in the US dollar, any weakening in the US dollar, this could be quite beneficial on a go-forward basis. So we shouldn't always just look at the, you know, the previous 10 years and say, you know, this is likely to persist for the next 10 years. I think you have a lot of dynamics that have changed that maybe are, you know, creating a setup where the US dollar could be weaker on a go-forward basis, not stronger. So that's the currency aspect. Now, the question about transparency, I think you referred to it as, if you just remind me again, the phrase, honesty in terms of governments, in terms of companies, I would say, you know, a term we use is transparency. And again, I think this is the real benefit of doing bottom-up fundamental research, is really trying to we meet with companies. We need to see if if their supply chain is real, if what they're telling us in terms of the sales, these are real operations, especially in countries where there has been a lack of transparency. Now, I think that it is, all investing involves risk, right? And you have to think that international investing has an added layer maybe of risk, and some of these markets, some of the emerging markets in particular, where the accounting standards or the transparency are maybe not to the same level that we tend to see in some of the developed markets, do include added layers of risk. But, we have a very large effort here at the organization in financial accounting, where we're really going through forensic financial accounting, really trying to go through and understand these companies from a transparency perspective and from a financial accounting perspective. But it is a risk that you have to take into account when you think about international investing. So when we think about multiples for these companies, when we think about the price we're willing to pay for these companies, transparency is often a big component of how to think about what the potential price you're willing to pay for an investment in these companies is.
Any other trustee comments or questions regarding the presented materials?
I have one other question.
Trustee Jordy.
So again, just briefly on the concept of something as simple as the International Dividend Appreciation Index, is that it's a screen for profitability. And if a company does not yield increasing dividends or consistent dividends over long periods of time, then inherently it can't be profitable. There's other screens I think that they're using for that, even though it's an index fund. So sometimes index funds will have a screen for profitability, like maybe they'll take out the highest yielding dividend companies, because those companies can be in kind of a death spiral where they're just increasing their dividends to the point where they're not reinvesting and improving their company and preserving market share. So there are screens that even index funds will use to kind of make sure you don't get into those, a dividend trap company.
Sure.
But the advantage of it is that it is a form of proof that the company is in fact profitable, versus say a growth company that offers almost no dividends or no dividends, but is promising profits in the future because it's in a growth economy, it's in a growth sector, and believe us, trust us, someday we're gonna produce a profit. And then finally, so I see that you were the one scheduled to make a presentation on this, and you have a extensive background. But in looking at this particular fund, I saw a list of names of people who were identified as managing the fund. And one of the requests I've had of MSERA staff is that when we hear about one of the funds that we're invested in, that we're actually hearing from one of the people who are picking the stocks, picking the companies. So I'm curious, are you one of the people who's picking the companies? You're just not on that list? Or trying to understand who I'd like to understand the thinking behind the people who are picking the stocks.
Sure. No, I am not I do not pick stocks for this particular portfolio. My role is the investment director, and in Vince's opening comments, he made reference to the fact that we employ what we call multiple portfolio manager system. So we use multiple portfolio managers, each chosen because they represent different viewpoints and different ways of thinking about the world. Each of these portfolio managers manages an individual sleeve of the portfolio. When we talk about the portfolio and we say the Euro-Pacific Growth Fund, we are talking about the aggregation of the investment ideas of 12 different investment professionals and the research analysts. So there are north of 100 individuals making investment decisions on this particular portfolio. Now, if you were to talk to one individual, a single individual portfolio manager on this strategy, that individual would talk to you about their individual sleeve of the portfolio. They would talk to you about the 10 or 20 stocks that they hold in this particular portfolio, and they would not really represent the aggregation of the way the investment group is thinking. So it would provide you with a very narrow view of how to think about a very narrow sleeve of this portfolio. So what the role of the investment director is to do is to sit with the investment team and to be able to represent the aggregation of all of these different investment decision makers to our end clients, if that makes sense.
Yeah, it does. So maybe in a quick summary, again, this portfolio visualizer, this particular ETF only goes back not quite 10 years. But if it earned 6.22% or 622 basis points over that 7-year period ending October of 2023, and if this fund actively managed earned, what was it, 505 basis points, so it's more than 100 basis points behind, what's the reason, and can you confirm that that's after fees, that 505 basis points?
This is 521 on there is, or 505 is net of fees.
Okay, so they're both net of fees. Portfolio visualizer is net of fees. So if it's 100 basis points less than an index fund that's commonly available and widely reported on, what's the reason for us to stick with this versus going with an index fund with a higher performance over a 7-year period?
So I think, I don't know what is in this Vanguard strategy that you talk about. You did mention that it has an international bend, it has a quality bend. I don't know if it is a strategy that looks at all of international markets or just developed international markets, developed or emerging. Those are two completely different things when you think about benchmarking. But I would just, if you looked at a 7-year time period, I mean, these are point in time, right? And I think the thing that we really pride ourselves on and gives people confidence, you mentioned that the index has only existed for 70 years. If you look at our portfolio, this is a portfolio we've been managing on behalf of clients for nearly 40 years. And what should give you confidence about our ability to continue to do this in the future is the fact that we've been able to do it so consistently in the past. And maybe I'll ask Sue to actually go forward to slide, I believe it's 33 in the deck. And this is, we talk about point in time, and you picked a very specific point in time, 7-year period. I would have to go back and look at my screens and see exactly what that strategy did over a 7-year period that gave you a better return than our strategy. But what this is showing you is the consistency of our strategy over that 40-year period. So we're looking at every rolling 3-year period since the inception of the strategy, every rolling 5-year period since the inception of the strategy, and every rolling 10-year period, right? They don't even have a 10-year period, but we have 354 rolling 10-year periods since the inception of this strategy to be able to say to you, 99% of the time on a rolling 10-year basis, we're generating excess return in this portfolio. And on average, it's not just consistency. It is the magnitude of the average excess return that we're generating over that period, over 300 basis points. So it's a very, very strong long-term track record of being able to consistently generate the excess return over time. So I think that's the difference.
Well, would you characterize that consistency as somewhat being reflective in the Sharpe ratio, Sortino ratio, or standard deviation? I mean, this particular fund has a standard deviation volatility of 14.59, or maximum drawdown at any one point was 26, but the worst year was just under 17%. So not phenomenal, but I've seen better, but that's not the worst either. It's not what I would characterize as highly volatile. I would say it's slightly less volatile than some other international funds. So do you have standard deviation or worst year in your report?
I don't think we have worst year or max drawdown in the report. We can get that to you. You will see standard deviation figures in our report. I think it's on page 35 of the report, where we'll show you standard deviation. Again, these are set time periods, so 3-year, 5-year, 10-year, and 20-year time periods, both relative to the index and then relative to our Morningstar category, which is the far and large growth category. And you can see if you looked at the standard deviation of this portfolio, which is what we would expect for a portfolio of this nature, that we have delivered the returns in the portfolio on those trailing set, fixed time periods with less volatility than the broader market.
Thank you. Do we have any other questions or comments? I would like to thank you all from Capital Group. I believe you're all in different time zones, so I appreciate you joining us at the same time. Thank you, Vince, Emily, and Sue. I don't believe we have any other items for them today.
Thank you very much. We appreciate your time. And again, look forward to keeping up to date on going forward. And everybody have a great holiday season.
Thank you. You as well.
Thank you.
Thanks, everyone.
Thank you.
The only other item under 5 would be the monthly investment performance report from Callan. Unless our financial investment officer had any other comments on that item, I believe that would.
I would only comment on that item. You can see a small rebalance that we did there. It was just a good time. Market was high at that point. So we've slowly worked our way back into very close to our asset allocation target ranges. And that's just furthering that effort.
Thank you. Do we have any public comment regarding any of items on 5?
There is no public comment.
I think it would be appropriate to take a break. It is 10, we'll call it 20. We can be back here for 10 minutes, 10:30 a.m. Welcome back. We'll call back to order the December 13, 2023 Board of Retirement meeting. The next item to call is item 6, discussion and possible action regarding an agreement with the State Street Bank and Trust for custodial banking services. I'd like to call our Financial Investment Officer, Mr. Vavelas.
Trustees, you have the memo for the contract amendment before you. I'd be happy to answer any questions or thoughts you have.
Trustee Harris.
Move approval of the State Street contract amendment.
We have a motion and a second. Trustee Harris and Cavness. Do we have any further trustee comments or discussion? Seeing none, do we have any public comment?
There is no public comment.
Ms. Zeller, if you could do a roll call vote, please.
Mr. Land?
Aye.
Ms. Cavness?
Aye.
Mr. Jurdy?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris? Ms. Pierce?
Aye.
Approved.
Item 7, the Audit Committee report and recommendation is our next item. Do we have an Audit Committee member that would like to speak regarding that?
I can just report that an audit, there was no audit opinion, and everything was, there was nothing that was found that is objectionable. We would recommend that that this board would approve the audit.
Thank you. Executive Director, you have any comment?
Thank you, Chair Cromer. I believe we had a good rapport with the auditors. When they completed their report, they did indicate that they were quickly served by staff, and I really want to just thank Judy and Robert for their work with the auditors to get the reports issued on time. As Ms. Cavness said, we received a clean audit, and there were nothing that rose to a level of findings. We have a couple of minor agreed upon conditions. The information is available for trustees to review at our office if you need. What we are looking for adoption of the financial statements and the independent audit report.
Thank you. Do we have any motion to adopt the financial statements and independent audit report as presented?
The recommendation from the committee acts as our motion,
Oh, I'm sorry.
Okay.
which does not require a second.
All right. We still have to vote on it. Do we have any further trustee comment regarding this item? How about public comment regarding item number 7?
There is no public comment.
A roll call vote, please.
Mr. Land?
Aye.
Ms. Cavness?
Aye.
Mr. Jurdy?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Ms. Pierce?
Aye.
Approved.
Brings us to item number 8, discussion and possible action regarding the Annual Comprehensive Financial Report, or the ACFR, and the Popular Annual Financial Report, PAFR, for the fiscal year ended June 30th, 2023. Executive Director Rentschler.
Thank you, Chair Cromer. We did attach both financial reports for the board's review. This is the second year that we've published the Popular Annual Financial Report. We did receive the GFOA's highest award for financial reporting for the Popular Financial Report, our first year out in issuing that simplified document to make a summary document available that's easier for laypersons to read. Our annual financial report also received the GFOA award for its achievement in excellence in financial reporting as it has in past years, and we're just providing those to the board. I believe it's just a receive and file.
Trustee Jurdy.
Yeah, so I want to thank staff for preparing the abbreviated popular version of the report. And question, do you happen to know how many of the other cereals in California also, I think I've seen a few on the web from other, I don't know if it was Marin, some other places I think I saw some.
I don't have the exact count of how many other cereal systems actually issue the popular annual report. I do know there are several that do not and a handful that do, but I don't have the count of the 20 systems. We wanted to make the information more readily available, and a lot of folks aren't going to dig through the 100+ page full annual report on our website. This one is much easier for members to get just a quick highlights of our financial and demographic information, and we thought it was a nice addition, so thank you for your comments. And I also would like to echo that appreciation of staff who worked on this.
Any other comments or questions from trustees?
I'd say it's a great addition, but the public can try to understand. I think if we had something like this a long time ago, it would be helpful.
Agreed, and the recognition that's received from this report, I don't want it to be diminished that it is recognized every year that I believe we've submitted it, but it I'm sure is a significant amount of work, and that should not go understated. Any public comment regarding item number 8?
No public comment.
We will consider both those items received and filed. Brings us to item number 9, discussion regarding the administrative report. Executive Director Rentschler.
Thank you, Chair Cromer. At last month's meeting, Trustee Jurdy asked about why our trustees had to pay the the waiver of recourse premium, and that actually has to do with Government Code Section 7511, which does allow the plan to purchase the policy as a whole, to protect the board as a whole, to protect individual trustees from being held liable. It does require that the trustee pay for this coverage with their own money, which is why we charge everybody the $9. If you have not already paid your waiver of recourse, please submit the premium to Judy by January 17th. With the renewal of our fiduciary policy, they provided some flyers on other insurance offerings they have, 2 of which I mentioned here, an additional crime coverage, which can be added, which has covers fiduciary dishonesty, essentially theft, forgery, and transactions like that. The other item is cyber liability insurance. I have been told by risk management of the county that we are covered under the county's policy for cyber security. However, it's been difficult to get confirmation that we have been actually named as an added insured to that policy. And because we have our Pension Gold software, which is not maintained by the county but is hosted for us by our pension administration system vendor, it might be worth looking into getting a standalone policy to ensure that it would cover us in relationship to our Pension Gold software in addition to the IT services that the county provides. That would need that we fill out an application in order to get a quote, so if there is interest from the board in receiving a quote on the cyber insurance policy, I'll work with IT to get that application submitted.
Thank you for the report. Is there any comments from trustees specifically regarding the cyber liability?
Yes. Please look.
Please pursue it is the direction I'm seeing and hearing.
Okay, I appreciate that direction. We're moving forward with Pension Gold updates. The 2023 tax update is being tested now, and the upgrades and release to implement the separate accounts or split accounts is targeted to be in our test environment by the end of February. We did provide the R.V. Coons report of public fund universes for the board's review. I also wanted to apologize. While I removed the Sackers legislative update from the agenda, I never actually removed that language from this administrative report. There was no legislative update for this month. If you have any other questions, I'm happy to answer any other questions.
And that was due to the timing of our meeting, correct? The
We haven't
Sacker-
received anything yet.
Yeah.
If anything comes in, we'll include it on the January report.
Any other communications from trustees or comments? Any public comment regarding the administrative report?
There's no public comment.
Thank you. The administrative report will be received and filed. Brings us to item 10, discussion and possible action regarding the employment agreement with Doris Rentschler for the position of Executive Director. As a summary, I can say that the Retirement Board met in closed session during the October 2023 meeting and gave direction to the negotiations team to proceed on this. The negotiations team met with the Executive Director after the October meeting, and the contract presented today for board approval is consistent with that direction and agreed to by our Executive Director. As a quick summary, the agreement includes a 3-year contract with increases of 5%, 3%, and 2% for each respective year. And in addition to any increases department heads may receive and any increases allowed under the department head MOU. And in year 2 and 3 of this contract, if the CPI, the California CPI, is below the scheduled increase for the Executive Director, the contract would have to return to the Board of Supervisors to approve it for year 2 and 3. And if it's below the CPI for that year, then it would not have to go and return to the Board of Supervisors. It would just be administered as the increase. And if approved today by the Retirement Board, this contract would go to the Board of Supervisors for approval as required under the County Employee Retirement Law. So that's the summary regarding this item. Is there any trustee comment? There. Go ahead.
Move approval of the contract.
We have a motion, a second from Vice Chair Shoemaker and Trustee Cabnis. Do we have any public comment regarding item 10, the agreement with our Executive Director and the contract?
There is no public comment.
We could take a roll call vote, please.
Mr. Land?
Aye.
Ms. Cavness?
Aye.
Mr. Jurdy?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Ms. Pierce?
Aye.
Approved.
Brings us to item number 11, general board member discussion. Do any trustees have items they would like to discuss? Trustee Harris.
I'd like to thank Quincy for doing a great job this past year, and Catherine being willing to take it on again. It's a lot of work behind the scenes that we hardly ever see. It's just been a magnificent year, Quincy. Thank you.
Thank you, I appreciate that. I appreciate everybody who is agreeable to take the positions for the next year, and I have a better understanding and respect for the amount of work it takes, so thank you.
Mr. Chair, I would echo the appreciation for the work you've done for us over the last year and in the years you're not chair as well. And I want to make a comment in regard to what has gone on at the county level in regard to employee negotiation and direction of the Board of Supes to look at studies for market rates for employee jobs and so forth. I know that that's been something that's come up around our employees, that there has been the HR department has gone ahead and tried to create equivalents to positions inside the county, and I think hasn't necessarily taken into account the specialty that we're working in this organization, the specialty that our employees do. And over the next few months, the county will move through these issues. I just want to let everybody understand that to some degree, we're a dog that's been left out on the chain, outside in the cold, and I don't believe our employees should quite be treated like that. And I know Doris is working very hard on this to make sure that they are brought to market, looked at in a manner compared to their peers across the state and the other cereals. And I just think all the board members are aware of this, and that there may be times board members may not to speak to others in this community about it. So.
Understood, and the only comment I would like to make regarding that is I don't believe any action's been taken by the Board of Supervisors regarding any of these contracts, and I believe HR's direction has been to gather the information and report it to the board. So I understand there may be some disagreement as to the comps or what is a comp, but I just wanted to make it clear that no action has been taken on those contracts. They've just been directed to determine what it would take to get units and employees to market if they so desired.
Yeah. Let me add to that actually I've talked with Doris about this, and I think us being possibly prepared to do an independent study might be something we would like to look at. And because I don't believe that the looks that are occurring are showing that some of the proper organizations are there too. But we'll see how this tracks out.
Understood.
And we might think about doing that.
Understood, thank you. Any other general board member discussion? All right, the notice of our next Board of Retirement meeting will be Wednesday, January 17, 2024 at 8:30 here in the Board of Supervisors chambers, and we will be adjourned. Thank you.
Oh.